Most advice about Social Security is based on fundamentally flawed math, and I can prove it. While everyone's telling you to delay until 70 because you'll break even in your early 80s, they're using calculations that ignore basic financial principles. When you fix their math mistake, that break-even age jumps from our early 80s to nearly a decade or more beyond that. If you're making claiming decisions based on these flawed calculations, you could be leaving hundreds of thousands of dollars on the table. Here's what we're covering. First, I'll expose the mathematical error that's skewing every break-even calculation. Then I'll explain why discount rates matter and what they should actually represent. Next, I'll reveal the 5 hidden risks that could cost you more than any benefit cut. We'll see what happens when you fix the math using a real research example. And finally, I'll give you access to a calculator that uses the correct methodology so that you can consider it in your future claiming decisions. Before we begin, this video is strictly educational and should not be misconstrued as specific financial or tax advice. Everyone's situation is unique and should consult a qualified third party who knows their specific situation. So let me show you the fundamental flaw that's driving terrible Social Security decisions across America and why it violates basic principles of finance. Every break-even calculator you've seen from SSA.gov to financial planning websites makes the same critical error. They assume $1 of Social Security at age 95 is worth exactly the same as $1 at age 62. But that violates the most fundamental principle in finance, the time value of money. Money today is worth more than money in the future. And Social Security, despite being government-backed, isn't exempt from this mathematical reality. So here's why that matters. When you delay Social Security, you're making an investment decision. You're giving up income today in exchange for higher income later. Like any investment, this trade-off needs to be evaluated using proper financial analysis. And this missing piece is called a discount rate. In corporate finance, when you evaluate any future cash flow, even guaranteed ones like treasury bonds, you discount them to the present value. Social Security calculators use 0%, which is mathematically impossible and financially irresponsible. Understanding a discount rate and what it is crucial for understanding the real math because it represents the opportunity cost of our capital. What you give up by not having that money available to invest elsewhere. When you delay Social Security, you're essentially buying a government bond that pays a higher income later, except it's deferred. So here's what this means in practice. Using a 0% discount rate, delaying from 67 to 70 might show a break-even age in our early to mid-80s. Using a proper 4% discount rate, that break-even jumps to our late 80s and pushing easily into our early 90s. Recent research from Smith & Smith in the Journal of Financial Planning confirms this, where they quote, "With a 4% real return, a person has to live to 89 for it to be beneficial to delay the start of benefits from age 67 to 70. However, 77% of 67-year-old males die before 89, as do 65% of 67-year-old females." End quote. That means 3 out of 4 men lose money by following the conventional delay until 70 advice when you use proper math. Now let me show you those 5 critical risks that traditional advice completely ignores and how they interact with discount rates to create a much more complex decision than anyone realizes. These risks don't exist in isolation. They compound the discount rate effect. Each one represents a reason why your personal situation might push you towards claiming earlier than the basic math suggests. Risk number 1, mortality risk, the asymmetric gamble. This isn't about life expectancy tables. It's about the asymmetric nature of claiming decisions. If you delay and die before your break-even age, you lose everything you delayed. If you claim early and live past your break-even, you still received years of benefits. Traditional analysis used mortality-adjusted calculations, but this misses the human reality. For someone with health concerns or family history of shorter lifespans, this mortality risk becomes a major factor in the claiming decision. Risk number 2, sequence of returns risk. This is potentially the most devastating risk and is amplified when you delay Social Security. Here's why it's so dangerous. Retirement spending follows what researchers call a distribution hatchet. Not quite as pretty as the 4% straight distribution rule. High early spending for travel and activities, lower middle years, and then high again for healthcare. When you delay Social Security, you're forced to withdraw more from your portfolio during the worst possible time, early retirement, when sequence of returns risk is the highest. Michael Kitz's research shows a compelling example. Mike, age 62, with $500,000 portfolio, retiring right before the 2008 global financial crisis. The research found that claiming at 62, this individual's hypothetical portfolio recovered and he never needed spending cuts. It ended with a $578,000 in portfolio value. Now, claiming at age 70 required spending cuts during the crisis and ended with only $171,000 in portfolio value. That's over a $400,000 difference in portfolio value, and this used actual market data from the global financial crisis. Here's why sequence of returns risk is exponentially dangerous if that example did not illustrate it well enough. A 20% loss requires a 25% gain to break even. A 30% loss requires a 43% gain to break even. A 50% loss requires a 100% gain to break even. When you're making larger withdrawals during losses, recovery becomes exponentially harder or impossible. Risk number 3, health span risk. Health span, the years you're physically and mentally capable of enjoying life, is typically going to be shorter than the lifespan that we have and more relevant for these planning decisions that we have. Money received at age 62 can fund experiences impossible at age 85. These experiences could be a whole host of things, like adventure travel to physically demanding destinations, active participation in grandchildren's lives and activities, starting new businesses or volunteer work requiring our energy, helping adult children during their peak need years. Money at age 85 has significantly constrained use cases due to our mobility limitations, our health issues, and our reduced social circles. Risk number 4 here is policy risk, and is beyond the 2034 headlines that we see. Everyone's focusing on the potential for a 20% benefit cut in 2034, but policy risk encompasses much more than this. Future changes can include increased taxation on benefits, lower income thresholds for taxation, modifications to the benefit calculation formula, or changes to the cost of living adjustments. Policy uncertainty typically adds a premium to financial analysis, making earlier claiming more attractive if we add a little bit to our discount rate, accounting for these additional risks when future changes are possible. Risk number 5, behavioral and flexibility risk. Research by Blanchett and Fink shows people spend about 80% of guaranteed income like Social Security, but only 50% of investment wealth. Delaying Social Security may lead to underspending during the healthiest retirement years, since we don't have that bottomless cup of coffee that we have from our guaranteed income stream that is Social Security. Social Security provides steady income but limited flexibility compared to portfolio assets. You can't access multiple months in advance, adjust timing for major expenses, or use benefits as collateral. When you delay and deplete portfolio assets, you're trading flexible wealth for inflexible income. So let's talk about a real-world application here and the research example. The John and Sarah case study from the Kitsis research. This article presents John and Sarah, both age 60, who represent a typical American couple. They're eager to retire but stressed about doing so without claiming Social Security. They're concerned about future benefit cuts. They're worried about longevity. Their parents died before age 80. They want to preserve portfolio flexibility for travel and helping their children. They have $500,000 of portfolio allocated 60% stocks, 40% bonds. They're eligible for a combined $5,000 monthly Social Security benefit at age 62, and they have a spending goal of $6,000 per month. Most individual advisors would tell John and Sarah to delay until 70 based on a simple break-even calculation showing they break even in their early 80s. But the research applies proper financial analysis the same way that big institutions value future investments, starting with a baseline of 4% as a discount to the future expected income of Social Security, and then adjusting for specific risk factors. So these key risk factors for our example, John and Sarah, would be mortality concerns due to their family history, sequence of returns risk because their spending needs would require 12% portfolio withdrawals if they delay, health span preferences. They want to enjoy retirement while healthy, flexibility needs for travel and family supports. When you account for these realistic factors, John and Sarah's optimal strategy flips completely. Instead of delaying until 70, the research concludes they should claim as soon as possible at age 62. In isolation, this would be blasphemy in many advisory circles, but now the research shows that for extremely wealthy individuals with unique circumstances, like those with $10 million or more in their portfolios, who can fund delays with tips ladders and have extreme longevity in their families, delaying might still make sense. But that's less than 1% of retirees. For the vast majority of Americans, like John and Sarah, proper financial analysis points towards claiming earlier than conventional wisdom suggests. Let me show you why the research community is starting to acknowledge these flaws in traditional Social Security analysis. Smith & Smith's findings in the 2024 Journal of Financial Planning concluded, quote unquote, "Our calculations do not support the presumptions that the vast majority of people who choose to start their Social Security retirement benefits before age 70 are making a mistake." With just a 4% discount rate assumption, remember, historical 60-40 returns average about 4.89%. 77% of 67-year-old males die before the break-even age of 89. 65% of 67-year-old females die before the break-even age. This means roughly 3 out of 4 men lose money by following the delay until 70 advice. Most Social Security research stress tests results at 2% real returns or 2% discount rates and calls it robust. But a 60-40 portfolio returning somewhere between 4 and 5% on average, or 4.89% from 1901 to 2022, their stress testing are less than half of the historical average. Now, I know some of you are still worried about Social Security's long-term viability. So let me address this directly because fear is driving bad claiming decisions. And there's certainly no shortage of flashing red headlines that we see plastered across all news outlets for the sake of getting your attention. Social Security operates as a pay-as-you-go system funded by current workers. About 79% of benefits come from current worker payroll contributions. About 21% comes from the trust fund surplus built up over decades. The trust fund earned $76 billion in interest in 2020 alone. When the trust fund is projected to be depleted around 2034, here's what it would look like. Social Security doesn't disappear or shut down. Benefits automatically reduce by approximately 20 to 25% to match incoming revenue. This is a funding shortfall, not a program elimination. The system continues operating with reduced benefits. And this is not the first time that this program has seen this over the years, and there are many different levers that can be pulled to rectify the situation. The program operates with impressive efficiency. Administrative costs are less than 0.5% of expenditures. The fraud rate is only 0.2% of payments that involve fraudulent overpayments. For every dollar that's contributed, over 99 cents goes to legitimate recipients. This efficiency exceeds most private sector financial companies. So the political math strongly favors program continuation. And there's historical precedent that Congress successfully addressed a similar crisis in 1983. And the most likely outcome here being that a combination of modest tax increases and gradual benefit adjustments. So now let's talk about your strategic plan and how we can actually interpret this for our situation. Remember that the massive financial cost that I mentioned in the beginning, it's the opportunity cost of following a flawed break-even calculation that ignores the basic financial mathematics and real-world risks. So our step number 1 framework here moving forward would be understand the real break-even math. Start with a corrected baseline, even assuming a conservative 4% discount rate, roughly equivalent to the government bond yields that Social Security may represent in future income. Break-even ages jump from our early 80s to our late 80s and early 90s. This alone changes the decision for most people. Step 2, assess your personal risk profile. Consider how the 5 critical risks apply to your situation. Higher risk profile favors earlier claiming. These things might include health concerns or family history of shorter lifespans, modest portfolio relative to Social Security benefits, plans to retire before full Social Security eligibility, strong preference for enjoying active early retirement years, concerns about market volatility in early retirement. Now, lower risk profile individuals may favor delaying if we have substantial wealth relative to Social Security benefits, family history of longevity into our 90s, the ability to fund delays with conservative bond allocations, and indifference to timing of income sources. Step number 3 here would be factoring in market protection. If you're retiring in the next decade, consider how claiming Social Security early can protect your portfolio from sequence of returns risks. Step number 4, run a comprehensive analysis. Use proper financial analysis that include realistic discount rates. There's no perfect answer here, but it's certainly not going to be a flat 0% unless you have real strong reasons for it. Your personal risk factors, spousal benefit optimization if you're married, tax implications and Medicare premium impacts, and multiple scenario stress testing is what all of this and a proper calculation and analysis should be doing. I've created a comprehensive calculator that implements this research-based methodology. Unlike simple break-even calculators, this factors in realistic discount rates that start with a 4% baseline and allow you to toggle on and off different levels based off of your situation. 5 critical risk categories with personalized adjustments, and multiple scenario analysis and stress testing. Spousal benefit optimization and spousal benefits and tax considerations are a limitation of this software, though you can download it for free using the link in the description below. This isn't just another break-even calculator, it's a comprehensive decision support tool based on proper financial analysis principles that is used across the board in analyzing other investments across the investment universe. Here's what proper financial analysis reveals about Social Security claiming. Number 1, mathematical foundation. The vast majority of traditional calculators violate basic financial principles by using no discount rates being applied. 2, a conservative reality. Even a conservative 4% discount rate pushes our break-even ages out nearly a decade later than advertised. Risk compounding. 5 critical risks make personalized analysis essential for most Americans. Research validation. Academic studies increasingly support earlier claiming when proper analysis is applied. Funding Social Security. Social Security will continue with likely modest reductions starting in the 2030s, not elimination. We need to stop thinking about Social Security as such a binary force, claiming as simple longevity bet, and start treating it as a complex financial decision that we have been paying into throughout our working careers and involves rigorous opportunity cost analysis using appropriate discount rates, comprehensive risk assessment across multiple categories, portfolio protection and sequence of return considerations, behavioral factors and spending psychology, and personal health and family circumstances. This last one being much more salient and being the one that we usually think about most, but not necessarily holding the most weight. The truth about Social Security isn't just that the funding fears are overblown. It's that the entire conventional wisdom about claiming strategies is built on fundamentally flawed foundations that ignore opportunity cost, real-world risks, and proper financial analysis principles. For many Americans, especially those retiring in the next decade with modest or moderate portfolio assets, with health concerns or family health history with shorter lifespans, wanting to preserve portfolio flexibility and spending optionality, planning active early retirement years while health permits, concerned about sequence of returns risk in early retirement, the optimal strategy may be claiming significantly earlier than conventional wisdom suggests, potentially at age 62 rather than waiting until 70, and banking that will end up making it into our late 80s, early 90s. Don't let mathematically flawed calculators drive your most important retirement decision. Download the calculator that involves proper financial analysis, input your real situation, and see what the enhanced mathematics reveal about your potential benefits. What surprised you most about this analysis? Drop a comment below. I'm curious to hear about what we're thinking about this and how we're actually going to be approaching it. And if this changed how you think about Social Security claiming, share this with somebody who you know is going through a decision in the coming years so that they can make an educated decision with one of their biggest assets that they have coming to them. Your Social Security claiming decision could be worth hundreds of thousands of dollars over your lifetime. Make sure it's based on correct mathematics, comprehensive risk analysis, and your personal circumstances, not the flawed assumptions that have dominated the space for decades.